Well, if you're long the stock market, you're having a tough day. Markets got walloped even further based upon the inflation news this morning, compounded on top of the additional tariff news from the week, bad consumer sentiment. Across the board, pretty ugly. Dow fell 715 points. S&P fell 112. NASDAQ fell 2.7%, 481 points. Pretty red today on Wall Street. The 10-year fell 12 basis points today, down to 4.24%. That is pretty massive move in the debt market. Obviously a flight to safety, so to speak, if you consider U.S. bonds safe anymore. Gold, likewise, flight to safety, put on about $25 an ounce as of recording the video. The metals markets don't close for about 20 minutes, but as of right now, gold's sitting at $3,082 a troy ounce. So what happened with the inflation report this morning? Out of CNBC, core inflation in February hits 2.8%, higher than expected. Spending increases 0.4%. Says the Federal Reserve's key inflation measure rose more than expected in February, while consumer spending also posted a smaller than projected increase. The Commerce Department reported Friday. What they said in the report is that the savings rate has ticked up. That means that there's less money sloshing around the economy. People are getting fearful. What they do have, which is not much, they are holding on to a bit tighter now. The core personal consumption expenditures index, or price index, showed 0.4% increase for the month, the biggest monthly gain since January 2024, putting the 12-month inflation rate at 2.8%. Economists surveyed by Dow Jones have been looking for respective numbers of 0.3% and 2.7%. So again, it came in more than expected, which means that inflation is going in the wrong direction, folks. Core inflation excludes volatile food and energy prices and is generally considered a better indicator of long-term inflation trends. And I believe it's the metric that the Federal Reserve most closely watches the most with it as it relates to its determination on setting of rates. Okay, so again, the markets take this as the Fed is not going to be able to quickly reverse course, start cutting interest rates when you have inflation going higher. It says in the all items measure, the price index rose 0.3% on the month and 2.5% from a year ago, both in line with forecasts. At the same time, the Bureau of Economic Analysis report showed that consumer spending accelerated 0.4% for the month, below the 0.5% forecast. Okay, so you have inflation going up, you have consumers spending less. Part of that is they have less to spend, right? So from my layperson perspective, that set the tone this morning for the markets, because that was released at 5:30 a.m. Eastern time, and the markets opened at 6:30. Okay, so 6:30 West Coast time. So anyway, we had a big sell-off, and I hope you guys are those are in the markets only making money when the markets go up, piling all your earnings to the extent that you have any into 401k plans, things of that nature. Those things are taking a big hit. Now, does everything go in cycles? Yes. Does it, what goes down must come up, the old adage. Well, if you lived through the dot-com bubble, what went down didn't come back for a long time. If you lived through the 2008 financial crisis, what went down didn't come back for a long time. So I'm not an economist. I'm just saying, be very, very careful. This could just be the tip of the iceberg. Many are out there, many analysts that have said, look, these markets were so overvalued, and there was such a absence of a real fair market value determination in the stock market any longer. With everybody chasing yield the money orgy over the past several years and all that stuff, that they're saying that this could just be the beginning, whereas the markets think, the participants, the stockholders believe this is hell on earth right now. Some are saying it could just be the beginning. A lot of uncertainty also in the administration. The old Trump put, right, that was in place during the first administration appears, at least now, to have exited stage left. Let me share the next story I saw this morning out of Payments, PYMNTS publication. And this builds on the theme of the debt-ridden consumer in this country, the defaults. This is car repos hit levels unseen since 2008 financial crisis. How many times in the past 2 weeks have I shared economic stories with you that discuss or revert back to the 2008 financial crisis as kind of the last time that they saw metrics this bad? Listen to this. Automotive repossessions reportedly jumped last year to the highest level in 15 years. Around 1.73 million cars were seized by lenders in 2024, Bloomberg News reported Wednesday, citing data from Cox Automotive. That was a 16% increase from 2023 and up 43% from 2 years earlier. It's funny, that 16% increase, I believe, in the story I did a couple days ago dealing with the student loan delinquencies, I think that number was also 16% of delinquencies on student loans. The last time car repossessions were at this level was in 2009, when the country was dealing with the fallout from the previous year's financial crisis. As Bloomberg notes, these numbers are another sign the Americans are having trouble staying on top of their monthly bills due to steep interest rates and higher car prices. And I will add that they're also buying more car than they can afford on terrible financing terms. The report says that car repossession numbers plunged during the pandemic due to relief efforts for borrowers. But when those measures ended and inflation jumped, borrowers began struggling to repay auto loans, leading to an uptick in repossessions. The number of subprime borrowers who were at least 60 days late on their loans climbed to 6.56% in January, says the most on record, according to Bloomberg, citing Fitch ratings. Meanwhile, purchasing a car has become more costly, with Cox data showing the average vehicle loan rose by 5 basis points to 10.16%. In February, the highest in 4 months, with the average monthly car payment coming to $748. The average monthly car payment is $748. That's insane. The news comes 2 months after the U.S. Consumer Financial Protection Bureau warned about a surge in repossessions. There's also recent data suggesting that access to credit could be tightening, according to the latest edition of the Survey of Consumer Expectations from the Federal Reserve Bank of New York. Well, they're going to be tightening a lot for those that have missed a payment, because those that have missed a payment, they're going 30, 60, 90, are toast. They won't be able to qualify for a loan for a car or for a house or for anything for the foreseeable future. If you get a repossession on a vehicle, guys, it's very similar to, as terms of the hit that it takes to your credit score, as a bankruptcy. Bankruptcy, foreclosure, and repos are kind of in the same basket. Again, not legal advice. I'm not a bankruptcy attorney, but that's my understanding. It says the survey found that rejection rates have risen across all major credit products, with the perceived probability of a rejection for auto loans coming to 33.5% for February, the highest level since the survey began. Data also shows that the percentage of consumers who expect credit access to deteriorate in the next year jumped to 46.7%, up from 42.3% in October of 2024. And concerns about higher prices have brought consumers' long-term inflation expectations to the highest level in more than 3 decades. So again, you've got higher prices, higher price tags for these vehicles. Look at the car lots. These vehicles are piling up in car lots, okay? We were at a Kia lot, I believe, a couple weeks ago with my daughter, and there was a there was rows of these Kia automobiles, every make, model, color, shape, whatever. I was amazed by that. So they're not moving these vehicles, okay? And the ones that they do, they're people are overpaying. They're taking on obviously substantial amount of debt that at least 16 point something percent of them shouldn't be taken on. So I'll leave it there with the economic news for today. Unfortunately, again, it's not uplifting, it's not cheery, but it is reality. You've got to have yourself grounded in what is actually going on, not what the spin doctors try to make you think is going on, so that you have your head in the sand. I hope that all of you agree with that approach. If you're watching this channel, it's funny. My dad the other day, I'm sure he's going to watch this video. He sent me a text and said, it'd be not, you start sharing some more of the uplifting news. And he cited some statistics to me, and I did respond, and I challenged a few of the things that he mentioned, but I said, it just right now, it just seems to be, and I look for stuff, but it just seems to be a lot of uncertainty, a lot of bad statistics like this. And when you get overwhelming stats like this, car repos worse since the financial crisis, home prices, out of reach for most Americans, defaults on student loans accelerating, commercial real estate default loans accelerating, and everything else going on with the administration. It's hard to reach. I almost feel like it's disingenuous to try to reach for something that is silver lining, because it's just not what's happening. It's really not reality. Will things change? Hopefully they will. Hopefully this is the bumpy patch, and that everybody can weather the storm, so to speak, and come out the other side and then get better, stronger, more credit worthy, more wealthy, all those good things. Obviously keeping their health the entire time, hopefully, and watching that as well. So I'll leave it there for today. Hope you guys have some plans for the weekend. Spend precious time with family and loved ones. Watch that health routine, diet, all those things I try to talk about at least on Friday afternoons briefly. Appreciate you guys again watching the videos, sharing them with people, family, friends, and loved ones, and subscribing to the channel if you haven't subscribed. So have a great weekend. If I don't touch base, I'll talk to you all first part of the week.